Before I expose the hidden connection that explains Bitcoin's entire price history, I need you to do something. Smash that subscribe button and stay with me until the very end. What I'm about to reveal will fundamentally alter everything you believe about cryptocurrency. I promise you the evidence will leave you stunned.
Last month, I was analyzing Federal Reserve balance sheet data when I discovered something disturbing. What I found explains Bitcoin's entire price history. The truth I'm about to share with you will forever change how you think about crypto. In my 25 years on Wall Street, I learned one thing: markets always tell stories, but mathematics never lies. The Bitcoin story might be digital gold, but its mathematical reality is completely different. Let me tell you about an experience that changed everything. 2 years ago, a wealthy client came to see me. He was a successful entrepreneur in the tech sector, had founded 3 companies in Silicon Valley and sold them all. He was quite knowledgeable about financial matters. "Tom," he said, "why is Bitcoin so volatile? Wasn't it supposed to be digital gold? Gold isn't this volatile." When I heard this question, lightning struck in my mind. I immediately opened my computer and put 2 charts side by side. The first chart showed Bitcoin's price movement, the second showed the Federal Reserve's balance sheet size. What I saw shocked me. The 2 lines showed almost perfect alignment. When the Fed expanded its balance sheet, Bitcoin rose. When the Fed shrank its balance sheet, Bitcoin fell. This wasn't coincidence. This was a mathematical relationship. I showed this chart to my client. "Here's your answer," I said. "Bitcoin isn't digital gold. Bitcoin is a liquidity barometer." My client was surprised. "But Tom, wasn't Bitcoin created to be independent of central banks?" he asked. "In theory, yes," I said. "But in practice it follows every breath the Fed takes." This discovery led me into deep research. That night at home I examined all of Bitcoin's major price movements from its inception to the present. I found the same factor behind each one: Federal Reserve monetary policy. The history was crystal clear. When did Bitcoin first make a major surge? In March 2020, after the Fed announced its massive quantitative easing program. When did Bitcoin experience dramatic decline? In 2022, after the Fed began raising interest rates. But this wasn't just a matter of timing. The depth of the relationship was much greater. During my time at Fondstrat, I spoke extensively with our institutional clients. Their perspective on Bitcoin was completely different from retail investors. Nobody saw Bitcoin as digital gold. They all called it a risk asset. A hedge fund manager told me, "Tom, trading Bitcoin is all about following Jerome Powell's speeches. When he speaks, we take positions." This man was right. Bitcoin's short-term movements were mostly determined by Fed officials' statements. Another institutional client said similar things. "When investing in Bitcoin, we look at Fed fund futures. If the Fed will raise rates, we sell Bitcoin. If the Fed will lower rates, we buy." I began to think about how this situation contradicted Bitcoin's original vision. Satoshi Nakamoto had designed Bitcoin as a monetary system independent of central banks. But now Bitcoin had become a prisoner of central bank policies. An incident with another client last year made this reality even more apparent. He was a retired mathematics professor who had taught at MIT. He was a very analytical thinker. "Tom," he had said, "Bitcoin's claim to be a store of value doesn't make mathematical sense. Gold has stored value for thousands of years, but Bitcoin isn't even 15 years old." I told the professor he was right. But I also explained to him, gold moves relatively independently of central bank policies. Bitcoin is the opposite. Bitcoin immediately prices in every Fed decision. This professor had asked a very interesting question. "So why is Bitcoin constantly compared to gold in the media?" My answer was because people selling stories ignore mathematics. Selling stories is easier than explaining mathematics.
The risk is clear. Thinking Bitcoin is digital gold can cause you to face major surprises when Fed policy changes. One of the most important lessons I learned on Wall Street was this: markets move with emotions, but they always return to mathematics in the end. The Bitcoin market is no exception to this rule. Here's the problem. Millions of people think Bitcoin is an asset independent of Fed policy. This misconception can be very costly. Let me tell you another client story. This client, a young software developer, was very excited about Bitcoin. He had read everything about crypto, did technical analysis, and understood blockchain technology. Tom, he would say, Bitcoin is a monetary system independent of central banks. What the Fed does doesn't affect Bitcoin. I patiently explained to him, you're right in theory, but you're wrong in practice. Bitcoin is currently part of the traditional financial system, and this system is under Fed control. This young man initially didn't want to believe it. But Tom, Bitcoin is decentralized. No one can control it. You're right about the technology. I said, but you're wrong about the pricing. Bitcoin's price is formed on centralized exchanges, and these exchanges are within the traditional financial system. This client's story could be seen as the story of millions of Bitcoin holders. Ideologically, they believe Bitcoin is independent, but in reality, they're dealing with a completely dependent asset. The problem is, this misconception creates surprises. Let me give another example. Last year, I had a family office manager client. He served a very wealthy family, managing $1 billion portfolio. This client had told me, Tom, the family is considering buying Bitcoin for portfolio diversification. It also provides inflation protection. We had a long conversation with this client. I explained that Bitcoin doesn't provide inflation protection. On the contrary, I said that because Bitcoin follows Fed policy, it could be very volatile during inflationary periods. But Tom, Bitcoin's supply is limited. Doesn't this give it store of value characteristics? He asked, having limited supply alone isn't enough. I said, demand is closely linked to Fed policy. When the Fed withdraws liquidity, demand falls. This family ultimately didn't buy Bitcoin because when they learned the truth, they realized Bitcoin didn't fit their investment philosophy. But the most striking example on this topic happened with another client. He was a very experienced trader in crypto. He had made a lot of money trading Bitcoin. Tom, he had said, the secret to making money in Bitcoin is following the Fed calendar. I take positions before FOMC meetings. How does this make it digital gold? I asked. It's not digital gold at all. He laughed. Bitcoin is like a derivative of Fed policy. Here's where the critical truth emerges. Bitcoin's price movements are so connected to Fed policy that experienced traders use this as an arbitrage opportunity. What does this situation mean? Those who see Bitcoin as a hedge against the system are in a major misconception.
Understanding what happened after the gold ETF was approved in 2004 shows the real impact of Bitcoin ETFs. Most people saw Bitcoin ETF approval as a major victory. Now, mainstream adoption is beginning, they said, but historical precedent tells a different story. Let me tell you a story from 2004. That year, the first gold ETF, Spider Gold Shares, was launched. Everyone thought this would be a major turning point for gold. Gold experts were saying at the time, now institutional money will enter gold. Gold prices will rise significantly. This is a game changer. What actually happened? The first year, the gold ETF was very successful. It collected billions of dollars. Gold prices also rose. But the interesting thing was that the gold ETF changed the character of the gold market. Before the ETF, gold was less volatile, more predictable. After the ETF, gold became more volatile. Why? Because the ETF exposed gold to equity market dynamics. Gold no longer just followed gold supply demand. It also followed stock market sentiment. I witnessed this change on Wall Street. Before the ETF, gold mostly moved with physical demand and central bank activity. After the ETF, gold began moving with risk-on/risk-off sentiment. The same thing is happening with Bitcoin ETFs. Before ETFs, Bitcoin moved more with crypto market internal dynamics. After ETFs, Bitcoin follows the rhythm of traditional financial markets. An experience with one of my clients perfectly exemplifies this change. This client, who managed a pension fund, was very excited when Bitcoin ETFs came out. Tom, now we can make institutional allocation to Bitcoin. This is a big opportunity, he had said. When we met again a few months later, my client was speaking differently. Tom, Bitcoin now moves like tech stocks. When Nasdaq falls, Bitcoin falls too. This correlation bothers us. This is the real effect of Bitcoin ETFs. It took Bitcoin out of the crypto ecosystem and integrated it into the traditional financial system. This integration made Bitcoin even more dependent on Fed policy. To give another perspective, let me tell you about a former FundStrat colleague. He did crypto research and had a lot of expertise. Before ETFs came out, he had told me, "Tom, Bitcoin ETF, it will be a big mistake. It will destroy Bitcoin's unique character." Why? I had asked. Because ETFs will turn Bitcoin into a commodity. Commodities follow Fed policy. Bitcoin's independence will end. This colleague was proven right. ETFs brought Bitcoin into correlation with Nasdaq. When Nasdaq falls, Bitcoin falls. When Nasdaq rises, Bitcoin rises. Why is this correlation a problem? Because Nasdaq is very sensitive to Fed policy. When the Fed is hawkish, Nasdaq falls. When the Fed is dovish, Nasdaq rises. Therefore, Bitcoin is now secondarily dependent on Fed policy. Fed Nasdaq Bitcoin chain reaction. Let me give another example, showing how dramatic this situation is. I had a client who managed a crypto hedge fund. He was a very successful trader. After ETFs came out, he told me, "Tom, trading Bitcoin now isn't much different from trading the S&P 500. Same risk factors, same correlations. Does this bother you?" I asked. Very much, because I had entered Bitcoin for my crypto expertise. Now macro expertise is needed. This change is also creating debate in the Bitcoin community. Original Bitcoin believers see ETFs as a betrayal. According to them, Bitcoin lost its independence for the sake of mainstream adoption. But here's the reality. This change is irreversible. Bitcoin is now part of the traditional financial system, and this system is under Fed control. Recognizing Bitcoin's mathematical dependency on Fed policy leads to understanding the real dynamics of crypto markets. Let me show you concrete data because these numbers are astounding. Look at Bitcoin's performance during Fed balance sheet expansion periods. From March 2020 to November 2021, the Fed balance sheet expanded tremendously. During this period, Bitcoin experienced astronomical growth from its lowest to highest levels. What happened during Fed balance sheet reduction periods? When the Fed started quantitative tightening in 2022, Bitcoin experienced dramatic decline. This isn't just coincidence, this is mathematical correlation. What I learned during my years on Wall Street is this: asset prices are directly related to liquidity. If the Fed creates liquidity, assets rise. If the Fed withdraws liquidity, assets fall. Bitcoin is no exception to this rule. In fact, Bitcoin is one of the assets most aligned with this rule. Why? Because Bitcoin doesn't produce yield. It doesn't pay dividends, doesn't give interest, doesn't generate rent. Bitcoin's only value proposition is price appreciation. Assets based on price appreciation are very sensitive to liquidity, because people only buy these assets when they think prices will rise. When they think prices will fall, they sell. When liquidity is abundant, people are willing to take risks. Demand for speculative assets like Bitcoin increases. When liquidity is scarce, people don't want to take risks. Demand for Bitcoin decreases. This is a mechanical relationship. Fed creates liquidity. Risk appetite increases. Bitcoin demand increases. Price rises. Fed withdraws liquidity. Risk appetite decreases. Bitcoin demand decreases. Price falls. This cycle is so predictable that professional traders use it as a timing indicator. A hedge fund manager client explained this system to me. They look at Fed balance sheet expansion rate. If expansion accelerates, they increase Bitcoin positions. If expansion slows, they reduce positions. Is it that simple? I had asked for Bitcoin. Yes, he had said. Bitcoin is a pure liquidity play. This mechanical relationship has another dimension. Interest rates. When the Fed keeps interest rates low, the opportunity cost of holding cash is low. People turn to risky assets. Bitcoin benefits from this. When the Fed raises interest rates, the opportunity cost of holding cash increases. People prefer places where they can get risk-free returns. Bitcoin suffers from this. Bitcoin holders who don't understand this dynamic face major surprises. A conversation I had with a client last year perfectly exemplifies this situation. This client, a successful business owner, had invested a significant amount in Bitcoin. When the Fed started raising interest rates, my client went into panic mode. "Tom, why is Bitcoin falling so much?" he asked. "Because the Fed is raising rates," I said. "Treasury bonds now offer attractive returns. People prefer guaranteed returns over risky Bitcoin." "But Tom, wasn't Bitcoin marketed as digital gold?" he asked. "There's a difference between marketing and reality," I said. "Reality is Bitcoin is a prisoner of Fed policy." This client later said, "Tom, nobody told me Bitcoin was so sensitive to Fed rates. This is the problem. The Bitcoin community mostly does technical analysis, ignoring fundamental macro factors. But the primary factor driving Bitcoin is macro policy." Here's another example showing how extreme this situation is. The effect of FOMC meetings on Bitcoin volatility. A client doing quantitative analysis had shown me this study. Bitcoin's average volatility on FOMC meeting days is 3 times that of normal days. "Is this normal?" I had asked. "Not at all," he had said. "This level of macro sensitivity is abnormal for a decentralized asset." This analysis made me think, is Bitcoin really decentralized, or is it a remote control of Fed monetary policy? Evidence points to Fed control. The most striking example is this: Powell's speeches immediately affect Bitcoin's price. Sometimes major price movements happen within minutes. A crypto trader client observing this phenomenon told me, "Tom, after Powell speaks, Bitcoin algorithms immediately make price adjustments. It's as if Bitcoin is software parsing Fed statements." This observation is very revealing. Bitcoin's price discovery mechanism gives instant reaction to Fed communication. This situation is in complete contradiction with Bitcoin's original philosophy. Satoshi Nakamoto wanted to make Bitcoin independent of central authority, but now Bitcoin follows every word of the central authority. What's ironic is this: the more mainstream Bitcoin becomes, the more dependent it becomes. ETFs, institutional adoption, regulatory acceptance, all of these integrate Bitcoin more into the traditional system. Integration creates a trade-off with independence. Bitcoin gains acceptance but loses autonomy.
Now, let's observe how you might adjust your approach to crypto markets by accepting Bitcoin's Fed dependency. This isn't a recommendation %. This is observing the patterns of successful crypto participants. First observation: experienced crypto traders move according to the Fed calendar. The approach I learned from a crypto hedge fund manager client was this: he reduces positions 1 week before FOMC meetings. After meetings, he adjusts positions according to the Fed's tone. Why this approach? I had asked. Because Bitcoin is very sensitive to Fed surprises. It makes sense to reduce risk before surprises happen. He had said. This manager also said, trading Bitcoin is now doing macro trading. Crypto expertise alone isn't enough. Second observation: long-term crypto holders do Fed cycle timing. A conversation with a multimillionaire Bitcoin holder client shows this pattern.
This client had entered Bitcoin very early and achieved big returns. "Tom, I now manage Bitcoin according to Fed cycles," he had said. "How?" I had asked. "I increase exposure at the beginning of Fed easing cycles. I reduce exposure at the beginning of tightening cycles." "Isn't this trading?" I had asked. "No. This is risk management." Bitcoin's character has changed. I changed my approach too. This client also added, in the early days we could buy and hold Bitcoin. Now macro awareness is needed. Third observation: institutional crypto investors see Bitcoin as part of their macro portfolios. A client managing a family office explained this perspective. "We don't see Bitcoin as an isolated crypto allocation. We see it as part of risk assets allocation." "What's the difference?" I had asked. Risk assets allocation is adjusted according to Fed policy. Bitcoin is part of this adjustment. This approach doesn't treat Bitcoin as a special asset. It evaluates Bitcoin in the risk assets category, like tech stocks or high-yield bonds. Fourth observation, crypto education focus is shifting from technical analysis to macro analysis. What I learned from an academic client who speaks at crypto conferences. Now it's mandatory to talk about Fed policy in crypto courses, because students want to understand the Fed's impact on crypto. This client also said, traditional crypto education is outdated. Knowing blockchain technology isn't enough. You need to know macro policy. This shift shows maturation in the crypto industry. The industry is moving from technical focus to financial focus. Fifth observation, Bitcoin correlation with other risk assets is stabilizing. A client doing quantitative research had shown this trend with data. Bitcoin's correlation with the S&P 500 is increasingly rising. Volatility is decreasing but correlation is increasing. What does this mean? I had asked. Bitcoin is transforming into a mainstream financial asset. It's losing its unique characteristics, he had said. Is this transformation Bitcoin's maturation or identity loss? It's a matter of perspective. Sixth observation, Bitcoin's narrative is evolving from value store to risk asset. This shift is seen even in marketing materials. In ETF prospectuses, Bitcoin is described not as digital gold but as an emerging store of value with high volatility. This language change is important because it sets expectations. People are beginning to approach Bitcoin not as a stable value store, but as a volatile risk asset. Final observation, Fed policy expertise is becoming a premium skill in the crypto industry. The trend of hiring macroeconomists in crypto funds is increasing. People with macro plus crypto hybrid expertise are preferred over those with pure crypto backgrounds. This change is an indicator of the industry's maturity. Crypto is no longer independent of macroeconomics. These observations show Bitcoin's evolution. Bitcoin has become a very different asset from its original vision. Is this good or bad? That's a judgment call, but this is reality. Bitcoin traded its independence from mainstream adoption. Now it's being played according to traditional financial system rules. Those who accept this situation can navigate better. Those who deny reality face surprises. Bitcoin is still innovative technology. Blockchain is still a revolutionary concept, but Bitcoin's financial characteristics are converging to traditional assets. This knowledge is useful because it does proper expectation setting, approaching Bitcoin not as magic internet money, but as a Fed-sensitive risk asset is more realistic. This perspective makes Bitcoin more predictable. If you understand Fed policy, you can better anticipate Bitcoin behavior. This insight is valuable because not correctly understanding Bitcoin's character can be costly. Final word, Bitcoin's Fed dependency is reality. Accepting this reality is the first step to better navigating crypto markets.